Last time I talked about the factors that would lead you to own your own home versus investing in real estate through a more detached means like a real estate investment trust or a limited partnership. And I didn't really come up with any overwhelming economic reasons to do it through home ownership. So this time I want to talk about the psychology that I think makes people want to invest in their own home and have that as an asset. And there may be other factors, but the two things that I want to focus on are pre-commitment and loss aversion. But first I want to just make the point that, for most people, housing is their biggest asset. So I took this data from a paper by Edward Wolfe of the Levy Institute. You see that he updates it to 2007, which is before a big decline in housing wealth, of course. So the first line I want to focus on is net home equity as a share of assets. So your net home equity is the value of your home minus the what you owe on a mortgage. And so for all households, that figure was 21.4% in 2007. That is, of all the wealth people had, they had about a fifth of it as net home equity. But for the top 1%, it was only 8.7% of their wealth. So they had a much smaller share of their wealth in housing and a much bigger share in financial assets like stocks. The next 19% had, so that's the rest of the top quintile, had 23.6% of their wealth in their homes. So they had much more. And then the middle three quintiles, 34.8%. So this just documents what I think we know to be true, which is that sort of for the middle class, this middle three quintiles, they're much more dependent on housing as a share of wealth than the top 1%. We might say, okay, well, the top 1%, obviously they're going to be limited in how much housing they're going to have. How much housing do you need? Maybe that's not such a big deal. But then look at this next line, which is gross investment in the principal residence. That is, we don't net out the mortgage debt, but we just look at how much housing is relative to wealth, and there it's really extreme. So the top 1%, you see 10.2% of their wealth tied up in their home, but in the middle three quintiles, 65.1%. Of course, the difference between this and this is that there's a lot of mortgage debt. But in gross terms, which in some sense gives you the exposure of the middle three quintiles to the performance of housing investment, almost 2/3 of their wealth is tied up in their homes, and that's just huge. That's enormous share of wealth tied up in personal real estate. And of course, we saw that since 2007, because house prices declined, you can see where that would be a huge hit to the middle class. So let's go back up to this psychology. What do I mean by pre-commitment? So why would so many households, why would our middle class want to concentrate its investment on their own homes and just have such a huge concentration? Why is it that we believe that 2/3 of our assets, in some sense, should be in our homes rather than having a more diversified portfolio of assets? And I think I've come up with a couple reasons, and there probably are others. One is pre-commitment, and that is when you buy a house, when you put down money and then agree to pay a mortgage, you're committed to paying off that mortgage, and that's committed to building up wealth. So you're forcing yourself to build up wealth. That's what pre-commitment means. You force yourself to save in some sense. Your saving consists of paying off your mortgage, and as we saw in some earlier videos, it's not really so much paying off the mortgage as the accumulation of equity that that you get from inflation, from the increase in house prices. But either way, you can say that you force yourself to save. And another reason that I just saw an article is loss aversion. So here's the article, and I want to zoom in on this paragraph that says, on an annual basis, housing investments have mostly resulted in gaining money while at the same time producing real losses more often. So what that means is in nominal terms, most years house prices go up, but we saw that the rate at which they go up has to be compared to the interest rate to give you a real interest rate. And so it could be that they don't go up fast enough to make up for your interest payments, but you still don't get a sense of loss. So people don't compare sort of nominal and real, and so they don't realize that they're losing in real terms. And as this article points out, people rarely lose in nominal terms, and in fact, even then, those losses you can often avoid thinking about, especially if it's just a small price change, because people aren't necessarily marking their housing portfolio to market every day, whereas if you invest in stocks and they go down, you see that right away, and you have no choice but to face up to it, even if you're not selling the stocks. But if you have a house and you don't really pay that much attention, you don't worry about it so much, then you don't have to feel a sense of loss every time market prices go down a little bit. So I suspect that these are a couple of the reasons why people hold so much of their wealth in their own homes. But it's an interesting question whether that's a good thing, something to be encouraged, or whether we ought to be trying to come up with other ways for people to pre-commit and other ways to overcome loss aversion in accumulating assets.